Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of corporate filings so you don't have to, in this case the BRINKS company, also known as that armored car company that moves money around. They just released their proxy statement, and I know what you're thinking. A proxy statement? That sounds boring. Well, it's anything but. Think of it as like a corporate treasure map, and in this case it points to some interesting clues about executive pay and where the company thinks it's going. First things first, this proxy statement is an invite to Brink's shareholders to attend their annual meeting on May 8, 2025 in Dallas, Texas. It's where they'll vote on important stuff like electing directors and approving their accounting firm. Speaking of votes, shareholders are being asked to elect 9 directors to the board. This is important because the board is basically the boss of the company and their decisions can make or break it. It also has a non-binding vote on executive compensation. Your vote matters. Brokers may not vote your shares on the election of directors or on executive pay without your instructions. If you want to read the whole thing, and I know you do, you can find it online. Let's look at some corporate governance highlights. This is basically Brink's report card on how well it's run. It brags that its board is very independent. That means people are not controlled by management and they have a separate CEO and chairman, so that one person isn't wearing all the hats. They also have a process to evaluate the board's performance and encourage all of its members to increase their skills through education. Apparently they put directors through a class about AI. There's a new thing this year, a sustainability report. It shows the company's carbon footprint. It also shows their commitment to employee safety and wellness. Now, a look at who is going to be on the board. Most of the nominees are independent. It shows that they are qualified individuals with a balance of relevant skills, as well as varied backgrounds and experiences. Brinks talks a lot about sustainability, which is surprising for an armored car company. They are trying to reduce their environmental impact through things like electric vehicles and solar panels, and they say they are committed to fair labor and ethical practices. Brinks emphasizes ethics and compliance a lot. They have a whole group dedicated to it. All employees have to do ethics training, and there are ways to report wrongdoings anonymously. The report boasts that last year, over 97% of the votes cast approved of the executive's pay. So clearly the shareholders are happy with how things are going. Let's move on to the juicy part, executive compensation, or in simple terms, how much the top dogs get paid. We're going to look at Mark Eubanks, the CEO, Kurt McMaken, the CFO, and a few other top executives. The stated goals of their executive compensation program is to link pay to performance. Basically, the executives get paid more if the company does well and less if it doesn't. The company changed how they calculate bonuses. They added a new goal related to revenue from digital retail solutions and ATM managed services. It appears they are putting more emphasis on those new ventures. So, how did the executives do last year? Well, it depends on which executive you are looking at, but in general, some goals were hit, some were missed. The annual incentive program company performance metrics factored in non-GAAP operating profit 50%, revenue 10%, AMSDRs revenue 15%, and free cash flow 25%, and meant if non-GAAP operating profit and revenue were below target, while AMSDRs revenue and free cash flow were above target. Those are some funky terms. It just means that some things looked good and some didn't. The executives also get bonuses based on long-term performance, and those long-term goals were exceeded. So overall, not a bad year for the top brass. For example, adjusted EBITDA is a common metric, which is like earnings before certain expenses. It is often used in these types of bonus programs, so things don't differ too much. There's also a note about not doing off-cycle grants and not making certain option grants, both which are good. The company highlights some of its compensation practices, which are pretty standard and are intended to link incentives to shareholders, pay for performance, shareholder alignment, and having an independent consultant. Some things that Brink says that they don't do is tax gross ups, which would cover the executives' taxes, which is nice. How do they decide how much to pay everyone? Well, they look at what other companies are paying. They use something called a Proxy peer group, which is basically a list of similar companies this year. That group includes ADT, FleetCor, Iron Mountain, and others. They're trying to make sure their performance goals actually match up with what the company is trying to achieve. That's why they set goals and relevant weightings like a focus on non-GAAP operating profit and another for cash flow. It looks like there is some individual discretion in these bonuses. For example, they gave the CEO a little extra for his visionary leadership. They also use a metric, internal metric PSU or IMPSUs, to incentivize leaders to grow. They also have an executive salary continuation plan, which put simply gives benefits to the executive's family in the event of an untimely death. Another important thing to note, the company's insider trading policy is designed to prevent trading on inside information. Finally, there is a stock ownership guideline that helps ensure that everyone has their incentives aligned with the shareholders. Now for the actual numbers. I hope you're ready for these. It looks like Mr. Eubanks, the CEO, got $1,371 and 800, or only 300,000, and it was the highest of the other NEOs. The long-term incentive plan is higher and is in the multi-millions, and it's meant to reward executives for sticking around and building value for the company in the long term. These incentives are based on metrics that are meant to align with the company's strategy, such as the EBITDA, as mentioned earlier, and the revenue numbers. Now let's take a look at the CEO pay ratio. This is how the CEO's pay compares to the median employee's pay. The CEO's pay is 699 times the median employee's pay. But here's the thing to keep in mind. Most of Brink's employees are located outside the US, where wages are lower, and those are seasonal employees. If you only look at the US employees, the CEO only makes 103 of MEC of her wages outside the US, where wages are lower, and those are seasonal employees. If you only look at the US employees, the CEO only makes 443 times more. The proxy statement also answers some basic questions like how to vote, what the board recommends, and how to attend the annual meeting if you are so inclined. The last proposal is to approve the selection of KPMG as their accounting firm. The audit committee is responsible for and says it has a good process for selecting its auditor. Looking quickly at the fees, most of the fees are as you would expect for the audit. Okay, that's the filing, so what do we make of all this? On the whole, it seems that the company is working as planned. Brinks is trying to adapt to a changing world where people are starting to use cash less. It can either die or try new things like digital payment solutions. A lot of what the plan is and the incentives are designed for shows the company is trying to push into new ventures to stay relevant. This kind of transition is hard for a lot of older established companies, and they can often stumble and fall as they try to adjust. It is something to keep an eye on. The executive compensation, which is the largest part of what's in this report, seems reasonable given where the company is going and the current targets. If this type of analysis was useful, make sure to like and subscribe for more of these. Thank you.